In 2020, something strange happened. Millions of people lost their jobs, businesses shut down, entire cities went quiet. And at the exact same time, the stock market exploded upward. Not months later, not after a recovery, immediately. It looked absurd, a global crisis on Main Street, a wealth boom on Wall Street. So here's the uncomfortable question. When new money enters the system, who touches it first? Because that answer quietly decides who gets rich first, and it's not random. Right now, governments are running historic levels of debt. Central banks are adjusting interest rates at record speed. Asset prices swing on a sentence from a press conference. Yet most people still believe wealth simply goes to whoever works hardest or whoever invests smart. But there's a system underneath all of this, a pipeline. And where you stand in that pipeline matters more than most people realize. Let's start at the source. When governments need money, they don't raid a vault. They issue bonds, IOUs. Investors buy those bonds, and in return, they receive interest over time. But when markets panic or economies stall, central banks step in. They buy those bonds, not with saved cash, with newly created digital money. No printing press, just keystrokes. This is where the system begins to tilt. The new money doesn't drop evenly across the population. It enters through financial institutions, large banks, investment funds, primary dealers. They are the first recipients. Imagine pouring water into a layered sponge. The top layer gets soaked first, the bottom layers wait. Banks now have fresh liquidity. They lend, they buy assets, they finance deals. Large corporations refinance debt at lower rates. Investors leverage positions. Asset prices rise. Stocks, bonds, real estate. Meanwhile, wages? Slow. Consumer prices? Eventually, yes. This process has a name economists don't love talking about in plain language. It's called the Cantillon Effect, named after an 18th century economist who noticed when new money enters an economy, the first receivers benefit before prices adjust. By the time the money filters down to everyone else, prices have already moved. In other words, proximity to the money source changes outcomes. Let's walk through a simple timeline. Step 1. Crisis hits. Markets panic. Asset prices drop. Step 2. Central bank injects liquidity. Interest rates fall. Bond buying begins. Step 3. Financial institutions access cheap capital immediately. Step 4. They buy discounted assets. Leverage increases. Step 5. Asset prices recover, then rise beyond pre-crisis levels. Step 6. Inflation eventually spreads to goods and services. Who gained the most? The ones who owned assets early, the ones who had access to leverage, the ones closest to the faucet. It's not a conspiracy, it's plumbing. Now, zoom out. The majority of household wealth in many developed economies is tied to financial assets. In the United States, for example, the top 10% own the overwhelming majority of stocks. That means when markets surge, wealth concentration surges with them. But here's the irony. The same policies that stabilize the system in a crisis, low rates, asset purchases, liquidity injections, also inflate the value of assets already owned by the wealthy. The system is designed to prevent collapse, but in doing so, it amplifies those who stand closest to capital. This isn't just about stock portfolios. Corporations borrow cheaply when rates are low. They refinance debt, buy back shares, and boost earnings per share. Executives tied to stock compensation benefit. Investors benefit. Meanwhile, small businesses without direct access to capital markets rely on bank loans, which depend on risk appetite and collateral. Different lanes, different speeds. And here's where it gets uncomfortable. If you own assets, you're inside the wealth acceleration loop. If you rely solely on wages, you're downstream from it. Wages tend to adjust slowly. Contracts, labor markets, negotiations, all friction-heavy. Asset markets move instantly. So when new money enters, asset prices often rise before wage growth catches up, if it catches up at all.
During the past decade, ultra-low interest rates made borrowing cheap. Investors searched for yield. Real estate prices climbed. Tech valuations soared. Venture capital flooded startups. At the same time, many households struggled with stagnant income growth relative to housing costs.